Great. Well, it's my pleasure to introduce my guest today, Rafael Cosman, who is the CEO of TrustToken, who are developers of a definitive unsecured lending protocol called Trufi, as well as 5 of the world's most transparent on-chain attested stablecoins, including TUSD. Rafael, welcome.
Thanks for having me on, Paul. Good to be here.
Yeah, of course. So I'd like to start with the recent transformation of TrustToken, which I'm not sure many are aware, but TrustToken recently did I don't know if you'd call it a pivot, but decided to focus more away from their stablecoin business, but more towards unsecured lending. And I'd be curious to learn about what was the genesis of that and what spurred the decision.
Yeah, so I guess you could call it a pivot. Maybe it's a partial pivot. But, yeah. We've been building a TrueUSD and a handful of other stablecoins for a while, and those are still products that we are involved with and are still growing. But the main focus of our company now is on Trufi, which is a DeFi platform that we launched recently. And I guess the thinking behind that was that we got into a point where we weren't quite sure how to take TrueUSD to the next level and how to grow it to be something of the size of Tether or USDC. And we saw how much potential there was in DeFi, which I think is partly enabled by technologies like stablecoins. And something we've been watching for a while. And we thought it made a lot of sense for us to make a move there. And we generally have been in this position of bridging between traditional finance and crypto and DeFi. And so with things like stablecoins, which kind of span both. And so that's why uncollateralized lending, where we're partnering with big borrowers like Alameda Research or Grapefruit Trading, but bringing those assets on chain and allowing people to just put in stablecoins and directly lend them out to these types of folks, that seemed like a perfect niche for us to try to fill.
And I'm sure it's been something you all have been watching since TUSD was initially created. Must have been some ideas you were kicking around internally.
Yeah, for a while, but I guess we've been watching DeFi and had never really figured out, okay, where really is there a valuable hole that we could fill? And then I think we pretty quickly saw, okay, actually uncollateralized lending, that is the thing. It was probably just seeing the success of protocols like Compound and Aave, but all of these protocols are targeting the over collateralized space, and there's almost no one targeting under collateralized.
And I guess, the question that I would have, because you don't really hear about projects or portions of projects, especially when they have a live or like a live token, in the sense that you had stable coins outstanding. Like, how does that get sold? I'm just curious about like how, in this new digital era that we're in, how a company like TUSD sells that part of the business. I'm just curious about how that worked.
Well, we actually, as one of the only major stable coins, we actually had been approached by many different folks over the years saying, hey, would you be open to, being acquired or to selling the product? And generally hadn't been open to the possibility until more recently. And, there was an Asian consortium that was just very interested in growing their crypto investments, and just saw a consortium that they made most of their money in real estate and other sort of more conventional industries, but just thought that, especially in Asia, crypto stood to play a very, very large role in how finance was going to work in the future, and they were interested in the possibility of buying and growing a stablecoin.
Mm-hmm. And so they manage like the strategic relationship, and my understanding is that you guys just run like the operational side of the business right now.
Yeah, we do the operations, the compliance, and we support on the technology side.
Oh, that's great. Well, it must have been fascinating because it's just, you don't hear about much of those happening. It must have been one of the first in the industry. Do you think so, or?
I'm not sure. I think these types of transactions, with TrueUSD, like, it's really important to us that our users know what's going on with it. And so, we made sure to publicly announce this in advance of the transfer actually happening. Mm-hmm. But I do think that for many transactions of this type does happen. Companies get acquired sometimes very quietly without it necessarily being publicly announced.
Yeah, well, that must have been just an interesting process to go through. I guess focusing a little bit now on your main focus, which is Trufi, which has its own token, is my understanding. And so when you were exploring uncollateralized lending, what other topics or avenues were you exploring within the DeFi space?
What other topics were we exploring? I don't know. We just been watching it for a while, and we've been watching it specifically with the lens of stable coins. Like what places stable coins would be most useful within DeFi, as opposed to stuff that's based primarily on Ether or other volatile cryptos. And lending is just one of the clearest use cases, because there's sort of like right now DeFi is exploding, and there's this this huge wave of farming which helps to grow everything. Protocols is giving out their tokens in order to help grow faster. But when you look at what are the actual fundamentals of DeFi, the things where where once all the farming distributions are distributed and so on, if you really got down to the fundamentals, what is sustainable, lending is one of the few things that really is like, it's a solid business through thick and thin.
And of course, like one of the main issues in crypto today is, or previously has been the fact that you need to put up 200, 300% collateral. So you saw that as one of the main issues and obvious issues, but what other problems around lending, specifically in the crypto space, did you guys see that you thought you could address?
I think the biggest one is just that collateral piece. I mean, our protocol is not that complex. There's a bunch of stuff we're working on now, like adding additional assets. So you can really think of it as very similar to something like a Compound or an Aave, but without having collateral. And the key thing is that, because Compound and Aave hold collateral, they don't worry about whom they're lending to. Any Ethereum address can borrow from those protocols. Whereas, of course, if you don't have collateral, you need to make up for that by actually being careful about who you're lending to. And so, we have to have high quality borrowers in the platform. And probably the biggest project that we're investing in right now is actually developing out a credit model, which is going to be something that's actually working on chain and take in information about these borrowers and determine, what should their credit limit be? Should they have any sort of risk premium? If we think that they're a riskier borrower, the protocol might want to charge them a higher rate compared to a borrower that has, let's say, a higher credit score.
So I have a bunch of questions on that, but before we get there, just for the users, if you could just describe listeners, not users, but if you could describe super quickly, just like how a user would get an unsecured loan on Trufi.
Yeah. Okay. So also most users use Trufi by being a lender, putting money into the pool. I guess to give you a high level of how the protocol works overall. Basically, there's a lending pool. Right now, it's got about 50 million TrueUSD in it, and anyone can come and just put some additional stablecoin into the lending pool. And then we work with a bunch of borrowers. These are oftentimes big funds that manage hundreds of millions or sometimes even billions of dollars of assets. Alameda, Grapefruit, Invictus, and so on. And you can actually see the whole list of all the loans the protocol has done. It's all public on chain, right? This is DeFi. It's every time a penny moves in or out of the protocol, you can see that. And those borrowers submit a loan application to the pool saying, hey, I'd like to borrow 5 million TrueUSD for 60 days at, let's say, 14% APY. And that's quite realistic. Borrowers right now are usually offering 14, 15, maybe even 16% APY for these loans, because these are funds that are trading in crypto, and there's a lot of things that they can do with that capital. So they're actually often making even more than that. So they're happy to borrow at those rates. But
and how, just curious, how are the interest rates? Is it, as a borrower, do I just get to say, hey, I want to borrow this at 5%, and no one gives me the money? Or is it, there's like because in the traditional world, right, you could use a 30-day treasury, 5-year treasury, whatever you want to use. And I'm always curious in the crypto world, what the interest rates are based on.
Yeah. So in the traditional world, everyone knows what the prime rate is, what the Fed funds rate and so on are. But here there isn't really an equivalent. So the protocol does have a minimum that is voted on by true holders. and that minimum right now is 10% APY.
Mhm.
But beyond that, borrowers can actually ask for whatever they want. But true holders, so the true is the token that governs the protocol, and true holders get to vote on if they want to approve a certain loan application or not. So if someone offers right now 12% or 13% APY, that'll almost certainly get rejected by true holders because they know there are other borrowers that are happy to borrow at 14, 15, or even 16. So
Got it.
basically right now you have to be competitive. But
Yeah.
once we have the on-chain credit model deployed, then that credit model is actually going to be taking into account, the riskiness of each borrower and pricing their loans slightly differently. And also we're going to be looking at the alternative places that the protocol could be deploying capital, like things like curve.fi. And so, curve.fi can be used as sort of a comparison rate. It's, I think the term risk-free rate doesn't really apply because there's no question Curve is not risk-free, but you can still compare, okay, if Curve is offering, let's say 12%, how do we think that this borrower's risk compares to Curve? And the protocol can actually price the borrower's loan, as a delta against what it's seeing in Curve and other sources.
Huh. And if I wanted to borrow, what would I need to submit to TrustToken holders as part of my sort of loan application?
So right now, you make a forum post. Every borrower has to make a post on the governance forum, which is reviewed by true holders. And then to even get on the platform as a borrower and to be able to submit loan applications, you got to make a forum post and you have to pass a vote by true holders. Mm-hmm. And in that forum post, you put information about, the history of your fund, what the use of your funds would be if you borrow from the platform, what kind of size and terms you'd be looking for from the platform. People actually share, to whatever extent they can, they share information even about their trading activity, daily or monthly volume, information like that. Of course, these firms are fairly private, so they can't share, everything about their trading, of course, because that would give information to their competition. But they know that they have to share at least some details, otherwise true holders are not going to be comfortable approving their application.
And so from what I've got, it seems like from what you've told me so far, your initial users are going to be sort of large trading desks that need short-term capital to execute trades, things like that? Or who is like the typical initial user, right? Just initially.
Right now it's large trading desks, but I wouldn't say short-term capital because they're often, right now they're borrowing we've mostly been doing loans about 30 days, but the true holders recently voted to change the maximum term to 90 days. And we now have a lot of borrowers borrowing, submitting applications for 90-day term loans. And in the future, it might even be 180 days or a full year. I don't think that these borrowers are looking right now for short-term capital. These are trading firms that they oftentimes have tens or hundreds of millions of dollars borrowed or invested at a time, and probably, will for many, many years. So they're just looking for working capital to do trading with, to do farming with, etc.
I see. And what is your hope is that, in the near term, it seems like a super logical use case. You can't have someone apply for a mortgage on TrustToken on day one. And it seems like it really, great beachhead market. But I guess, what kind of use cases are you excited about, in the medium term, let's say, for people using TUSD, just not just maybe for trading purposes, but for something else?
I think that our growth actually right now needs to be more on the lender side than the borrower side, because we've got, we've got something like 5 to 10 firms that are already onboarded, and more coming on every single day. There's a lot of folks that want to borrow capital. And these are like big, legit firms. For some of them, they might take out a $10 million loan. And for them, it's that's small potatoes. For Alameda Research, their $10 million loans they take from Trufi, honestly, they do it because they're they're interested to participate in the platform and to be a part of it and to help it grow. But for them, like $10 million barely moves the needle. They want to borrow like 100 million plus. If they could borrow 500 million, they would probably do it. So, these are big fish. They can borrow a ton of capital and oftentimes already have, 100 millions or even $1 billion plus under management. So I think a lot of our growth right now, we're really more focused on the lender side of, okay, we got a $50 million lending pool, right? That is actually pretty small compared to the demand that we're seeing from our borrowers. So we need to grow that from 50 to 100 to 500 million, hopefully within the next couple months or the next year or so we can actually start meeting the demand on the borrower side.
And for that lending pool, my assumption is that it's only to USD, or can users contribute other forms of stablecoins as well?
Right now it's to USD, but we're actually about to add support for other assets. And that's going to be, at first, that's going to be only whitelisted assets. But, as the platform more fully decentralizes, we're going to actually open that up, similar to how like on Uniswap and SushiSwap, anyone can create a pool with any asset. It's actually going to be like that, where you can take any asset, you can stick it, you can just call a function to create a new pool, stick $1,000 of that asset in, and then borrowers can come and start borrowing that out. And we'd like it to become at some point, a kind of rite of passage, just like how every new project that launches a token, one of the first things they do is they go create a SushiSwap and a Uniswap to trade their token and probably put some liquidity in so that people can actually trade it, right? Because they want to get their tokens into people's hands. And if it's not out there, with the market, then there's not much that people can do. But similarly, we'd like to be on that list as well, where you don't just create a Uniswap and a SushiSwap, you also create a Trufi pool. And then that now, Alameda and Nibio and these very legit borrowers that oftentimes provide most of the liquidity on centralized exchanges, they can borrow your token. They can actually start providing liquidity on centralized and decentralized exchanges using that token, and that can get your token into way more hands than just having it on a couple of dexes.
So also, I guess pulling that thread, it could be like at the same time they're also opening a credit line. Could you view it that way as well? For like operationally, if the company wanted to?
A credit line in what way?
Well, I guess, it's just a thought that came to my head, but, companies need to borrow money to run operations from time to time. Sometimes it's short-term working capital. Sometimes it's long-term, but it could be interesting where it's just they're immediately through some mechanism on Trufi. Not only do they create this pool, which provides liquidity for their token, which ultimately helps them with, as the token price increases, they have more money, but also maybe there's also a mechanism as like a line of borrowing, so to speak, with the token as collateral. But I don't know if you've thought about that at all.
It's not something that we support or are planning on supporting, because that's really in the domain of the collateralized lending protocols, like Compound and Aave. If they wanted to launch something like that, they could. But for us, like, you put a token into Trufi, you don't get to borrow anything against that. Like, we're not a collateralized lending protocol. Our focus is on uncollateralized lending. So you can put in a token and then earn a very attractive return on that. And someone will be borrowing that out and pay you an attractive return denominated in that token. But we don't let people borrow other assets against those tokens. Because we want to be a DeFi building block, laser focused on the uncollateralized lending piece. You can take the TF tokens that are emitted by our protocol. It's like you put some Paul token into Trufi, you get TF Paul, right? Which is, it's a token that represents your deposit into the Trufi protocol. Like, just like how you put DAI into Compound, you get CDAI. You put USDC and you get CUSDC. Similarly, you put Paul token and you get TF Paul. You can then take TF Paul, you could put that token on Uniswap. You could put that on SushiSwap. You could even, if it's supported, you could even put that onto Compound or Aave and actually borrow against it. But we don't want to add that kind of collateralized borrowing aspect to our protocol if we feel like it can be done by combining our protocol with something else. Does that make sense?
Yeah, no, it does. That's super interesting. I guess going on to the credit portion of it, could you talk a little bit about how you think about credit, risk scoring, those types of things? Because it seems there's not a lot of companies doing this in crypto today, and I'd be interested to hear about how you're thinking about credit scoring. And really, it's just a risk score ultimately, but how you're thinking about that.
Yeah, so that's a big one, and I think that credit scoring aspect, it could actually be one of the things that ends up being most useful about our protocol in the long term. In the short term, people are just excited about, okay, I can earn 60% APY using Trufi. We're offering great rates because people are willing to pay real money for these uncollateralized loans. Mm-hmm. But in the long term, having a credit score directly associated with your Ethereum address, that's something that other protocols could actually consume in the future. So you could imagine another protocol, even something like Compound or Aave that does over collateralized lending, you could imagine them saying, well, okay, Paul, if your Trufi credit score is above 600, then we're actually going to reduce the amount of collateral that you need to provide. Whereas someone else who has no credit score on Trufi, they have to provide, the full 150% collateral or 180% collateral or whatever is a very safe margin. So what we're doing to create that credit score is we're combining both off-chain data, like actually information about the fund that's doing the borrowing, and even information, even some somewhat proprietary information about their trading position, which can actually be provided in a zero knowledge way. So the idea is as follows. This is something that's actively being developed. It is not something that's in production yet. But let's say, Paul, you are a big trading firm, like Alameda Research or an Invictus and so on. You've got positions on a whole bunch of different exchanges. Okay, you would never want that information to be public about what your positions are on all those exchanges. But we could have a secure enclave on a processor in AWS, which could even be run and managed by you. And this secure enclave can actually connect to your exchange accounts and use a read-only API key to pull information about your positions. And then it could compute some very high-level metrics, like, overall, how leveraged are you? Or, how exposed are you to Bitcoin or Ether taking a big crash? They can compute those high-level metrics, and then they could actually output either just those high-level metrics or even bundle them into a single credit score that it's computed. And they could upload to the blockchain just those high-level metrics as well as a proof of computation showing that they were actually computed the way that they're supposed to according to the credit model. And then the smart contract can take that number, it can check the proof of computation so it knows that that number was computed correctly, and then it can use that to determine, okay, Paul, we're extending you a $15 million line of credit. And you would never want all of that data about your position to be public, right? You wouldn't be comfortable with that. But if you have it computed on a secure enclave and you know exactly what's happening, and just a proof of computation is being uploaded to the blockchain as well as an aggregate number, then that's something that you might feel totally comfortable being public. Like, everyone just knows you have a certain credit score and it was computed in this manner. They don't see the data that went into that. So we're combining that kind of off-chain data as well as on-chain data about, okay, Paul, you've already paid back 3 loans successfully for, with a total of $18 million. And so, that can be added in to your credit score. And that's something which is completely public and completely trustless. That's all directly on the blockchain for everyone to see. So combining both sorts of data, we can now say, okay, your Ethereum address, we can immediately just say, has this credit score, and you could even take that to other protocols and start using that directly. We think that's very powerful.
Yeah. And I guess I guess you're just trusting people to supply, because a lot of people have 10 Ethereum addresses or wallets, right? So
yeah.
Are you just trusting people to supply, I guess, how do you solve that problem where, or are you doing some sort of predictive, to see which wallet address are associated with each other that gets included in the score? I'm just curious.
Right. Like if someone might
like I might have 50 wallet addresses, but for the purposes of the loan, I might only submit 10, right? My 10 best. That looks like I'm a super prime borrower, right?
Right. Yeah, that's definitely a tricky problem. And, like if you have assets elsewhere, then that's okay with us, right? Like, we know that you have at least this many assets because we can see your Ethereum address, or we can see information about your exchanges that you're trading on. But I guess the issue is if you have exposure elsewhere. So like, let's say we look at your position, it looks like you're fully hedged with respect to Ether, right? You've got $1 million Ether position, but you also have $1 million short somewhere else, and it looks like you're fully hedged. But then it turns out there's actually some other protocol, so either some other DeFi protocol or some other exchange where you actually have, a massive Ether position or a massive Ether short, right? And we don't realize that. It looks, based on the data that we have, that you have this fully hedged position, but outside of that, maybe you actually have a giant short, or there's a huge risk somewhere that we're not seeing. That is definitely a tricky problem, and it's something that our team is actively looking into, of like, how can we be in a position where like any additional information beyond what the protocol is seeing, that could only improve your credit score, but we don't want to have risk. So we need to assume that there could be something out there that could be pretty bad from a risk perspective or from a volatility perspective.
Yeah. And where are you in the development of this like product? Is this something that is live, or?
The risk modeling side, this is ongoing right now. And so we're expecting in the next couple of months to actually ship something live on chain that's going to be looking at this type of data. But there's still a lot of work that has to go into it.
Yeah, I'm sure it's an interesting problem. And is it going to be like a credit score in the sense of like, my credit score when I'm looking at my, when I'm applying for a credit card loan or something like that? Or is it going to be more towards the line of like what Moody's, let's say, does, where it's like this firm has a AAA rating?
That's still TBD. I'm not sure that it matters that much. I think it might be somewhat cosmetic about whether you call it, okay, AAA, AA, or like, is it a score, up, through 760, or is it just 1 out of 100? Or I think that it's somewhat cosmetic. And then I guess what ultimately, you need to make clear what that credit score means. And then what ultimately matters is like, what kind of credit limit does that score correspond to? Like that's where the rubber really meets the road. If we say, okay, the meaning of this score is 600 or less, you just can't borrow on the platform, right? 600 to 700, you get a $3 million, credit limit. 700 and above, you get a $8 million credit limit, and so on. That's where the credit score really becomes meaningful. I'm not sure how we're going to represent it. Is it going to be more like a Moody's bond rating, or like a consumer credit score, like from Equifax? That's still TBD.
Yeah. Well, I guess playing devil's advocate, so far I guess, my response would be like, well, so far, playing devil's advocate, I would ask the question, well, so far, having no credit score hasn't seemed to be a big problem in the crypto space. But I would imagine your response would be that it's all fully collateralized lending, right?
Exactly. That's right.
Yeah. So I guess, but there's no other, at the moment, there's no other platform that does uncollateralized lending, or?
They are popping up. We're seeing a couple new ones are coming out every month now. And I think that, our protocol is probably inspiring some people too, which is good and bad. But I think we're probably the first, so we're in a good position. But it could end up being like Compound and Aave, where there's a couple of big players down the road, and maybe we're just one of them.
And is your hope that, because it strikes me that the credit score could be used widely, is your hope that, like, for example, all we could know is that Aave could be developing their own credit score, Compound could be developing their own credit score, and then further down the line, is your hope that, just like in the legacy world, there's, a bunch of different credit scoring firms. I mean, there's like 3, right? or is like do you think each individual protocol is going to have its credit scoring? I'm just curious about how you see the future there.
I don't know, but I think there's also a question of, okay, if our protocol does become a de facto go-to credit score for other protocols to consume, is there actually a way, excuse me, is there a way that our protocol can benefit from that? Because the credit score will be on chain. It's not like our protocol could easily charge people to use that information. It might be that anyone can just grab that information directly from calling our smart contracts. And so maybe the way that our protocol would benefit from it is just that, like, if it's well known that Trufi is the place you go to establish your credit score, then that can bring borrowers, high quality borrowers, to us first. Because people, just like how, you go get a mortgage, and then that is a way that you build your credit score over your lifetime. People may see it as like, okay, well, go to Trufi, take out a loan, pay it back, and that's the way you build out your credit score. And they'll know, hey, if you default on your Trufi loan, that's going to really screw you, not just in terms of your future on the Trufi platform where you're not going to get any more loans, but also across all of crypto, everyone will see that you defaulted on that loan. And so it's going to be much more difficult for you to get loans elsewhere. So you're going to be resetting yourself back to zero.
Yeah. Have you thought about how, like, the role it plays? And because there's a question in the chat about identity.
Yeah.
And this seems very complementary to what an identity is, because part of your identity, at least in the developed world, is credit. And so have you thought about how, I mean, that's probably super further down the line, but have you thought about how that is like a complementary to what someone's identity is? And plus it could also just be, I guess you've thought about this as well, but it doesn't necessarily need to be a person or a group of people applying for a loan. It could just be a bot ultimately.
Right. It could be a bot. It could be a smart contract, like another protocol. Excuse me. Really any Ethereum address can potentially be a borrower on our protocol. But, right now, those are all actual businesses. And on the identity side, we do KYC every single borrower that comes on our platform. So we basically are our own identity solution right now. Like, our company KYCs them. And that's probably, even once our platform is fully decentralized in the future, we will probably be one of several different KYC providers that will be, making sure that borrowers are who they say they are. But I do think that there is an interesting tie in there. If someone came up with a really good identity solution for crypto, being able to tie Ethereum addresses to actual businesses and individuals and say, like, okay, this address that supposedly belongs to Alameda Research, we know for sure that it does, and we've actually KYC'd them, and here's the proof that we're uploading that says that we've done that. If someone came out with a solution of that type, I think we'd be all over it, and we would love to have that be a part of our protocol, because we're looking to really focus on the uncollateralized lending side and the credit scoring side. But the establishing someone's identity, that's an important part of the credit scoring, but it's not the piece that we necessarily need to focus on. If there was a solution, there just isn't today. So if you have one and you actually are getting success with it, then we should talk.
Yeah. Someone also popped in a good question here in the Q&A, and in the legacy world, right, Moody's, FICO, they score people, but they're not actually making loans. So the question is if you're lending and doing a credit score, is that a conflict of interest for objectivity in the score?
So I think that it's actually the opposite of a conflict of interest. I think it's aligned interests, because if you give a credit score but you're not actually lending anything to that person, then it's not clear what is, you don't have any skin in the game. If your credit score turns out to be wrong and someone's a terrible borrower, but you gave them a 700 credit score and then they default on a loan, well, what did you lose, right? You just gave them a credit score, it turned out to be wrong, you didn't lose a cent, right? The lender that actually made that loan loses the money. Our protocol, yes, it's giving credit scores and it's giving loans, but that means it's got skin in the game and that its credit scores are more meaningful. You know, when if our protocol says that you, Paul, have a high credit score, then our protocol will put its money directly where its mouth is, and it will actually give you a line of credit associated with that credit score. So if we're wrong, then our protocol is going to take the hit, and if we're right, then our protocol is going to reap the benefit in those interest payments that you're going to pay.
That's fascinating. I mean, I'm super interested to see where it goes. And I'm curious to see what my credit score would be. But anyway, so
a credit score at first is going to be only for businesses,
Yeah.
for like crypto trading funds, not for individuals, but we might get there down the road. I would mention though, that just like how Experian and Equifax and TransUnion, how they get data from all kinds of different financial institutions, similarly, our protocol is going to need to be pulling data from Compound and Aave and Maker and all kinds of other protocols to say, okay, have you, Paul, successfully paid back loans on other protocols that can help to establish your credit score with Trufi? So we'll want to be taking that into account, and that could even become at some point like an open API where any other smart contract can submit to our smart contract information about someone's loans. Now, of course, we know that that information is legit, but we'd like to be collecting that from as many sources as possible.
And how did you, because I would imagine you approach trading firms and they're like, we're not going to give you our trading data and trading history and stuff like that. And we're certainly not going to be publishing it on public forums. Was ZK knowledge, like ZK proof, like boom, the first thing that came to mind, or was it more of a discovery there about how to solve around that problem?
So that actually, there's another company that we're partnering with to develop out that solution, and it's still early days, so I don't want to overpromise on this, but they really have been working on that side of like figuring out what would trading firms really be comfortable with sharing, and that's useful. Solving that problem is very useful for both the centralized lending market. Like, let's say someone like Genesis or BlockFi is making a loan to a trading firm. They want to know, okay, how do we know these folks are legit and are not overexposed or taking too many risks? But what we're doing is we're taking that same sort of technology, which is right now being developed for the centralized lending market, and we're putting it into the decentralized lending market, and that is really a first. But we do actually have this already, I'd say like in pilot phase right now, just working behind the scenes with a couple of our borrowers, where we actually have this set up where their data from their actual exchange accounts, this isn't with all of our borrowers, it's just with a couple that we're piloting this, but their data is actually getting sent to a secure enclave. The numbers are getting crunched there, and then high-level statistics are viewable by our team. And we don't have that. We don't have the second piece of that built yet, of taking that data and actually putting it on chain with a proof of computation. But already the fact that they're comfortable with that, when I'm sure they wouldn't be comfortable with just giving us their trading data or their exact positions, but they're comfortable with this setup where there's a secure enclave in between crunching the numbers. That already is a very big step and tells us that we're onto the right track here.
Makes sense. There's a question in here. Typically I reserve these to the end, but since they're pertinent to the lending conversation that we're currently in, I'm just going to go ahead and ask them. But Eduardo asks, being a startup and a potential borrower, what can be the use cases for us to borrow TUSD at a high rate APR and for short term? And can loans be extended or paid off early at request?
Yeah, so right now the protocol only does fixed term, fixed rate loans. So loans cannot be extended and they cannot be paid off early, or at least you don't get any sort of discount or savings if you pay them off early. We are working on a line of credit product, which will be borrowing at potentially a higher rate, but it's a flexible line of credit where you can pay it back and you can pull out more at any time up to some total credit limit. But I guess what I would say about borrowing at these high rates is that, look, Eduardo, if you're a startup, if you don't have a way to directly make more than, let's say, 16% APY by borrowing capital, then it probably doesn't make sense for you to borrow capital at 16% APY. Our borrowers, they are doing some combination of farming and trading in crypto, where they are able to on a regular basis, weekly and monthly, they're able to consistently make well over 16% APY. Oftentimes they're actually making 20, 30, or even 40% APY, and they're pocketing a significant profit if they borrow at 16 and then they're trading or farming and making 30. They're just pocketing a profit every month. And so that's why they're happy to borrow at these rates. And they know that, they could have a bad month and end up making less than these amounts and taking a loss, but they know that over the long term, they are pretty consistently able to beat these rates. And that's why they're willing to pay them.
So you launched in November, Trufi, is that right?
Yes, that's right.
So how has it gone so far?
Well, we've grown pretty well since then. The lending pool is at 50 million. We've already done a ton of loans. I can actually pull up the numbers here if you're interested in seeing. But
yeah, that would be great to see. You should be good to share your screen. So
okay, if that's okay, yeah. So this went from being in just the dream. It says host disabled participant screen share.
Oh, classic. Sorry, apologies. Oh well. Hold on, Josh is gonna have to be the one to do it since I believe he's the host now. But
cool. I think
we should be good. There you go.
Can you see this?
Yep.
So basically, this is actually, it's a DeFi protocol. So everything is 100% transparent on chain. You can see the status of every loan that the protocol has ever made or ever will make. It's all on chain. That's part of.
And the names of these not by the associated wallet addresses, but because they borrowed under the forum post that they said they would borrow on, for example.
Exactly. That's right. And every borrower actually goes through a KYB, know your business process before they can borrow on the platform. So we know, at least as best as we can, looking at their documents, etc., that they really are who they say they are. So that's how you know each of these names. And if you look here, we've done here, so Alameda Research, $3 million loan, $5 million loan, $10 million loan. These, and you can see here the status. So these loans, we haven't had a single default since launch, 0 defaults so far. And in terms of repaid loans, I think we're probably over $30 million repaid at this point, which is pretty good given that we launched just a few months ago. And these are, this $30 million successfully repaid, including all these very attractive interest rates. Here you can see a lot of interest rates like 11% and 12%. More recently, if you look at some of the loans that have just recently become active, here you can see 15%, 16% with Bastion Trading. These are even more attractive APYs, and these are getting fully repaid on a regular basis with very, very attractive interest rates and no defaults so far.
What have been some of the biggest challenges or so far since the launch?
Biggest challenges? Well, I'd say dealing with smart contracts in general is super difficult and super stressful because there's so many DeFi protocols that have gotten hacked that, my worst nightmare is we end up with a hack. And my team, we're just doing everything we can to try to avoid that. But there's also this, the industry moves so fast and there's so many features that people want that, we have to make sure, okay, we want to move quickly, we want to get features out there, but we absolutely have to prevent, our protocol from getting hacked and losing money. I'd say that's one of the biggest things.
Has anything been easier than expected?
Anything easier than expected? I'd say like getting from 0 to $50 million in the lending pool happened faster than I would have expected. I thought it might be harder. Now the journey from 50 million to 500 million, we'll see how that goes. I think also just like building stuff and shipping it and having people understand how to use a new product, that has been definitely slower and more difficult. than
What are
expect.
some, like, what do you think are some, because I think this is a problem that a lot of founders face. So what are some like wisdom that you could impart in terms of shipping the product, but also telling people how to use it and sort of dog fooding it is a term we use a lot. So what are some, shared learnings that you have to impart there?
I'd say, um, I'd say in in traditional startup wisdom, you do everything, quick iteration cycles. I think that in DeFi, because we're developing smart contracts, unfortunately, we have to move a little bit back on the spectrum towards waterfall development, where like, you plan everything beforehand, then you build it and you test it and you release it, and it's this much slower product cycle. Um, so I think that like, I guess my advice for any other DeFi founders would be, find a compromise between those two, where you're still being safe and you're not risking people's money, but you're still moving at the quick pace this industry moves. And I don't think it's easy. And I'd also say everything always takes longer than you expect, even if you expect it to take longer than you expect.
I think that's really good advice. Yeah. And one thing would, in our previous conversation, you had mentioned how focus is super key. And I think it's another common issue I see with founders where they're trying to do too many things at once. So it'd be great if you could just elaborate on how important you think focus is and to keep a narrow, like at least for your initial, when you're just shipping a product. It'd be great to hear your thoughts on that.
Yeah, I'd say that importance does not just apply when you're just shipping a product. Even once you have a live product like we do, I think it actually becomes even more important to focus on focus, because there are so many temptations. There's so many other things that people want from our protocol, but sometimes you have to channel Steve Jobs a little bit and say like, look, they, yes, you want feature A and you want feature B and feature C, but like, here's our roadmap, you know, like, I don't care if this feature is that you want is a good idea. I agree it's a good idea. I agree it's a nice thing to have, but is it more important than getting through this roadmap? Because we know like these are the steps we have to take to actually become a truly great uncollateralized lending protocol. And a little feature that's a nice to have, like, yeah, we could build it, but we're taking time directly away from what we know is the critical path. That's what you have to remember. It's like, it's not about, and that's I think an important aspect of focus that I think every founder needs to remember is like, it's not about, is something a good idea? Does it seem like it makes sense? Does it seem like it would help users? The question is, is it higher priority than the top thing on your roadmap? That's the question. And so that's what you have to keep coming back to. And I say that several times a week to my team, is I say like, look, this kills me. I know our users want this feature. I know it would be great to have, but is this really higher priority than continuing along our roadmap? And usually I think the answer is no, because like, you as a founder and as a team, you oftentimes know where you have to go, and you have to do a certain amount of, make sure your users are happy, make sure that the product is easy to use, but also you just need to get there, because if you don't, someone else will, and then they're going to end up being the ultimate protocol for uncollateralized lending, not you. That's how you have to think about it.
And you talked a little bit about your team, and I think this is another area where early stage startup founders kind of struggle with as companies grow. But how do you what have you found are best ways to manage a team? And because I startup early stage startup follows like a sine curve. There's peaks, there's valleys, there's peaks, there's valley, and when you're in the valley, it feels it can feel pretty destitute at times, I guess. And so how do you keep the team motivated together, all those things when that portion when you're in a valley, to get to the point where you're at, back at the peak?
I think that the thing that keeps teams together through the valleys is, we've got this, one of our values on our team is seek truth. And that's a very important idea to us, seek truth. And part of the idea is that, I'm not right because I'm the CEO. I have to argue for my ideas and explain why I believe what I believe, just like everyone else on the team. And if we ever have a time where someone on the team feels like they can't challenge my ideas because I'm the CEO and they're not, then we've got a serious problem and we need to address that. And that, I think, is the thing that keeps teams together through thick and thin. Because if our company is not doing well, our token is down, our protocol is not growing well, whatever's happening, if our company is not doing well, if people feel like, look, the CEO made bad calls, management made bad calls, the company is not doing well, and do I really want to be a part of this? Is my heart still in this? They're gonna want to tap out, right? It's different if you feel like, look, we're in this together, okay? If we make good decisions, we make them together. If we make bad decisions, we make them together. Yes, sometimes I'll have to make the final call because I'm the CEO, but we're always going to discuss together why we're making this decision, what direction we're choosing to go in. And wherever possible, if it's an important decision, we're going to have the whole team on board with it. And so, yeah, if we have to go through some pain because we're going down a certain path and we don't know, is it going to pan out yet or is it not? And sometimes it takes months, sometimes it takes years. But if we're making that decision together and we understand why we're doing it, then people will really have commitment.
I think that's I think that is a great way to manage a team. I think that's great advice. We had two questions pop in. I guess I'll ask this. I think the second one is a little bit more relevant to this point, but was there an inflection point at which you guys said, aha, this is what we're going heads down on, or was it sort of a process over time?
Oof. Well, definitely when we launched Trufi, that was an aha, we're going heads down on this. And that's also, candidly, that's how it felt in March 2018 when we launched TrueUSD. We launched TrueUSD. We were the first major stablecoin, the first USD-backed stablecoin other than Tether. And we knew, Tether's reputation is just very, very harmed by their lack of audits, et cetera. And we knew we were onto something and that stablecoins were going to be huge, and said, okay, we're going all in on this. And then, over a couple of years, as the market developed and several big competitors emerged, it eventually became clear, okay, well, we don't quite have the resources as a team to be able to take this to where it needs to go. And, that's painful. It's kind of like giving up a baby,
Yeah. But now that goes, I guess that's part of the peaks and valleys. Now you feel like, you wouldn't have made another decision, right?
No, I wouldn't. And I don't think that we'd be here today. I don't think that we'd have the understanding of DeFi that we have today, or the trust of the crypto industry that we have today, if we hadn't built a really legit stablecoin. And I think that set us up very well to take our next step of, something a little farther out there, going into uncollateralized DeFi lending. But I think with the reputation that we built and the things we've learned, I think people trust us to do it.
Yeah.
But but you're in this as a startup, you're in this crazy world, and you never know what the future is going to hold. And so you have to always be willing to say, okay, what is the world telling us right now about how we have to change and how we have to adapt? And if you don't,
I think that's great. You got to listen to, external, just got to listen to where you got to be able to pivot. You got to be nimble. It can't be wed to your ideas. I think that's great. I'm going to ask, someone had a question, but I think it's more related to a question I wanted to ask a little bit earlier, and I know we only have 4 minutes, but how do you build a two-sided marketplace?
Okay. So in an n-sided marketplace, there's usually only one side that is really tough. That's the important thing to remember. And it's usually the side where the money is coming in. So, example is if you have a marketplace like Amazon, if people are willing to pay money, I can promise you the sellers will come. Like, sellers are out there, they want to make money. If there's money to be made by selling stuff on Amazon, by selling stuff on eBay, by driving for Uber, those people will come. I think that for most multi-sided marketplaces, the biggest problem is where the money is coming in, getting those folks. And yes, you sometimes have to seed both sides to get things started. But then as you're growing, there is usually just one side that is the bottleneck. And for us, right, at least right now, it's the lenders. And I think that it will probably be the lenders for quite a while, because that's where the money comes in. If there's so many firms that we have that want to borrow nine figures, if possible, maybe even 10 figures, and we just don't have the capital to be able to give it to them right now.
And so what was was customer feedback whiplash tougher to manage as you were exploring what the product would look like in market?
I'm not trying to understand.
Sam, was customer feedback, when you were exploring, I guess, building the Trufi marketplace, was there a lot of customer whiplash and pulling you in all these directions into how the product should look?
Well, before it was
it like tough to manage? I think I'm trying to interpret the question as well, but I think that's what it means. Just similar to like mentor whiplash, which I'm sure you've experienced, where mentors are telling you, you ask for advice and you get 50 different advice and you don't know where to go. I guess on the customer side, you talk to 50 customers and they all want something different. So I guess, was that tough to manage, and how did you go about that?
So this guy, so this is a little off color, so forgive me, but this guy John on my team, he says something that I think is pretty apt. He said, opinions are like assholes, everyone has one. And there's no question, advice can certainly lead you astray as a founder and as a team, but advice from your, direct requests from your users, that's gold. That is real signal. That's not like someone telling you, you should do this. That's someone saying, I want this. I would put more money with you if you built this. That is real signal. And usually as a startup, you're in one of two phases. You either are having to build a product and push it into people's hands, or you have people pulling the product out of your hands. And you want to get to the point where people are pulling the product out of your hands, and it's not you as a founder or as a team having to sit in your armchairs and theorize about what you hope people want, but it's more about, okay, can you give them what they want fast enough because they're clamoring for it? And that's where every startup wants to get. And you learn as an entrepreneur to know, once you've seen both, you know how to differentiate what it is. When you've only seen one, you don't quite know what the other side is really like. But I guess the thing that I'd say is that, when you're in this state where users are pulling product out of your hands and they're just clamoring for more features for faster development, then you have to still be willing to prioritize and stick to your guns. If hey, I know this thing is not something people are asking for right now, but this is where we have to get long-term if we're going to succeed. You still have to be willing to stick to your guns on that kind of thing, and balance that against what our users saying that they want right now.
Yeah. And, because I've been a user of some of these products and I've asked questions directly in the chat, and it just makes me and maybe this is just me, but it makes me so much more a loyal user if I get a response right away. And I remember one time I got asked, what would you like to see? And I had never gotten that question. And it was just an amazing question to get from a company whose product I was using. Anyway, and it just made me a loyal customer. So anyway, it was really, really, huge, super huge. We are out of time, and we could keep going, and I don't want to keep you any longer, but this has been great. A lot of topics that we've covered here. I'm going to borrow a question from Michael, who works on your team. But how can we as a community be helpful to you and Trufi?
Wow. Well, I appreciate your asking. So A is come and participate in our protocol. So, you have stable coins, come put them in our lending pool. You can earn 50, 60% APY right now. If you have True or want to acquire True, get some True and stake it with a protocol that has like 90% APY. If you are a trading firm or knowing trading firms, they can apply to us to be borrowers on our platform. We're onboarding every month, every week, new borrowers. But in addition to that, we're also growing the team. We're especially looking for Solidity developers right now. So if you or someone is looking to actually build this kind of stuff, please talk with us, as well as other kinds of engineers, front end, full stack, building our front end, building other parts of our product. So,
and what's the best way to reach you?
Contributions. Best way to reach us is probably to join our Discord community. There's a link to that. There's a link to that on our site, app.trufi.io. And maybe there's also a way we could post some links to your community and to the podcast after this.
Yeah, would be happy to do so. Rafael, thank you. It's been a real pleasure.
Oh, thanks for having me on. It's been great.
Thank you. Thank you very much.
All right.